Welcome to XM.com for today's daily market comment by Rafi Boyadjian. I'm Cristina Marujos. After a short-lived bounce back, the Japanese yen resumed its free-fall in currency markets on Monday, sinking against all its major peers. The latest nosedive came after the Bank of Japan offered to buy unlimited amounts of 5 to 10-year Japanese government bonds, capping the 10-year yield precisely at the upper target of 0.25% of its yield curve control band. With other central banks on a sure path to normalize policy amid burgeoning inflation around the world, the yen has little support right now. The US dollar is scaling fresh highs today, hitting the 124 yen level for the first time since August 2015. Meanwhile, the dollar index is headed back up towards its two-year peak as rate hike bets have been heating up. Futures markets are now pricing at least 8.5 25 basis point rate increases for the rest of the year. The hawkish sound bites at the Bank of Canada have also been getting louder lately, helping the Loonie climb to two-month highs versus its U.S. counterpart. The euro and pound, on the other hand, have been struggling as investors are skeptical how much the ECB and Bank of England will be able to tighten given the inflation squeeze on consumers. However, the U.S. economy isn't free of recession risks either. A key part of the U.S. yield curve has inverted today, with the 5-year Treasury yield rising above the 30-year one. But the latest jump in yields hasn't proven to be much of a headwind for equities, as stock markets around the world have mostly recovered from the sell-off that was sparked by Russia's invasion of Ukraine. That could change, though, if the rally in government bond yields doesn't slow down. U.S. stock futures are pointing to a subdued start to the trading week, but European stocks are looking more upbeat, likely buoyed by the cautious optimism around the next round of ceasefire talks between Russia and Ukraine that's due to take place in Turkey on Tuesday. In Asia, however, China's benchmark CSI 300 index ended the day 0.6% lower after authorities placed Shanghai in a 9-day lockdown to contain a fresh spike in COVID-19 cases. Oil prices tumbled by almost 4% on the news, while reports that the U.S. is considering releasing more of its strategic petroleum reserves also weighed on the commodity. Thank you for watching the Daily Market Comment here at XM.com. Have a great week.